Right. Write down. Completion and review. Completion and review. Completion and review. So as I told earlier, if I take your syllabus, there are planning area, there are performing area, there are reporting, completion area. So we finished planning part, we finished performing part. Now we are at completion and reporting part. Okay. So under this, ISA 560 subsequent events. ISA 560 subsequent events. Under that, write down adjusting events, non-adjusting events, auditor's responsibility over subsequent events, within bracket, active duty and passive duty. Active duty and passive duty. The next one, audit procedures over subsequent events. Audit procedures over subsequent events. Clear? The second point, going concern. Going concern. ISA 570. Going concern, ISA 570. Under this, meaning of going concern, director's responsibility, auditor's responsibility, going concern indicators, Audit procedures over going concern. Audit procedures over going concern. Reporting implications. Reporting implications. Next one. Overall review of financial statements. Overall review of financial statements. ISA 520. Overall review of financial statements. ISA 520. Under that, review procedures. Evaluation of misstatements. So evaluation misstatement ISA 450. Uncorrected misstatements. Uncorrected misstatements. Uncorrected misstatements. Next one. Written representation. ISA 580. Written representation. ISA 580. Meaning of written representation. Purpose of written representation. Process of obtaining written representation. Reliability of written representation. Clear? Right. So this is the flow chart. Copy this. Copy this. Students, if it is possible, do that mock paper and come by tomorrow. Right? At least the section A. And if you can. Right. Now write down examinable points. See, even though this is theory, it's very, very important. Even though it's theory, it's very, very important. The first point, write down application of IAS 10 events after reporting period. Application of IAS 10 events after reporting period. Under that, adjusting event, non-adjusting event, adjusting event, non-adjusting event. Number two, auditor's responsibility. Auditor's responsibility during comma, number one, active duty period. Number two, passive duty period. Number three, passive duty period. Right. Yes, there are two passive duty. Write it down. Later I'll tell you. Okay. So if you want, mark like this. Year into audit report sign. Audit report signed to financial statement issued to management. Financial statement issued to management to publish to shareholders. Next point. Audit procedures to be performed over subsequent period. Audit procedures to be performed over subsequent period. Audit procedures to be performed over subsequent period. Next point. Management responsibility over going concern. Management responsibility over going concern. Next one. going concern indicators. Next one, going concern procedures. Next one, auditor's responsibility. Over going concern. Auditor's responsibility over going concern. Next one, overall review procedures. Overall review procedures. Next one, evaluation of uncorrected misstatements. Evaluation of uncorrected misstatements. Evaluation of uncorrected misstatements. Next one, purpose of obtaining written representation. Purpose of obtaining written representation. Why we should obtain written representation? The process of obtaining written representation. The process of obtaining written representation. Reliability of written representation. Reliability of written representation. Implication if management refuse to give written representation. Implication if management refuse to give written representation. Clear? That's all. Copy? Right. So let's move to the standard first, right? So IAS 10, events after reporting period. Write it down. IAS 10, events after reporting period. Standard. IAS 10, events after reporting period. Right. As per the standard, the events two type. One is adjusting events and non-adjusting events. As per the standards, there are two types. One is adjusting events and the other one is non-adjusting events. What is adjusting events? Condition exists at subsequent period to confirm that financial statements require adjustment. So the condition exists at subsequent period to confirm that financial statement require adjustment. Subsequent means events after reporting period. I'll tell you what is subsequent period. Yeah, subsequent period, the condition exists, but actually the particular thing is related to the current year. Okay, this should be what financial statement adjusted. Adjust in financial statements. Non-adjusting events, again this is subdivided into two. Going concern get affected. Going concern not get affected. Going concern get affected. Going concern not get affected. If going concern affected, treated as adjusting event. Financial statement prepare breakup basis. Financial statements prepare breakup basis. Going concern not affected, further subdivided into two. Material, not material. If it is material, disclose. Not material, ignore. If it is material, disclose. Not material, ignore. Yeah. See, I'll explain the subsequent event. It's like this. Copy it. Copy it. It's like this. 1st of January 2020. 31st December 2020. March 31st or 30th? 31st March 2020. Then June 30th June 2020. July 31st, right? All these are 21, right? Clear? Dates understood. This is your starting period. This is your year end. I'll give time, don't write. This is audit report signed. This is financial statement issued to management, and this is financial statement published to shareholders. It's published to shareholders. Concentrate. Subsequent period means events after reporting period. So our reporting period is this. From this date to audit report published to shareholders. Up to this date, it is known as events after reporting period. Events after reporting period. And this period we call subsequent period. Subsequent event. Understood? So the period between year end and financial statement published to shareholders. This period is known as events after reporting period. Okay. Actually, if I take within this period, events can be adjusting event and non-adjusting event. Adjusting event should be adjusted in the financial statement. Non-adjusting events, if it is affecting going concern, it should be treated as adjusting event. If it is not affecting going concern and material, disclosure is required. Non-adjusting event, immaterial, then you can ignore. Understood? Now let's comes to ISA 560. This standard speaks about auditor's perspective, auditor's responsibility. See, again I am telling, year end to audit report signed. Year end to audit report signed. Audit report is with auditor. AR means audit report. Audit report with whom? Auditor. Always it is with auditor. Between year end to audit report signed, audit report is with whom? With auditor. Audit report signed to financial statement issued to management. Between this period, audit report is with either auditor or management. Both possible. Sometime audit report with auditor, sometime audit report is with management. Audit report issued to management and financial statement published to shareholder. Between this period, audit report is with always management. Is this clear? Based on this, auditor's power determinator. Auditor have more power during active duty. This is what we call active duty. Why I am saying active duty? Auditor have more power. Auditor hold audit report. This is what we call passive duty. This is what we call again passive duty. So if you take the power of auditor, the level of interference can make by the auditor, the level of interference is very high when it comes to active duty. Passive duty comparatively less. The next passive duty very less. Understood? So ISA 560 standard, it provide guidelines to the auditor during this period. This is your active duty period. Auditor should perform. Auditor should perform audit procedures. See, underline the auditor should perform audit procedures over subsequent events. So, auditor should perform audit procedures over subsequent event during active duty period. It is mandatory requirement for the auditor, right? But when it comes to the passive duty period, it can be the period between audit report signed and financial statement issued, or financial statement issued to management to publish to shareholder. Both are passive duty only. During this period, auditor do not have responsibility. Auditor do not have responsibility to perform audit procedures over subsequent event. But if auditor realized any subsequent events, any subsequent events arise, then he should perform procedures. You got my point? So the performing audit procedure is mandatory during active duty period. Performing audit procedure is voluntary during passive duty period. Is it clear? Understood? Copy this. Copy it carefully. This flow chart is very, very important. Always remember who hold audit report. Huh? Train. Active duty who hold audit report? 100% auditor. Passive duty 1. Right, let's make it like this. Passive duty 1 and passive duty 2 for your convenient. But in your exam, normally it says passive duty. Huh? Passive duty 1, who hold audit report? There is a possibility of management holding report. There is a possibility auditor holding report. Does MOC 4 have chapter 11 and chapter 12? I didn't get what is MOC 4? MOC 3 is MCQ. MOC 4, you mean that Kaplan?
Ask them to refresh that. There is only 3 MOCs.
Only 3 MOCs uploaded to this app. You mean that the complete paper which I shared, PDF paper? Is that you said MOC 4? I think so far I uploaded only 3 MOCs. Okay. And the period, yeah, third MOC is, third MOC I include chapter 12 and chapter 11 as well. Better to do it tomorrow. So once I'll complete the topic today, both. So tomorrow you can do it, no worries. So passive duty 2, which means the financial statement issued to management and published to shareholders. Who hold audit report? Always management. Understood? Right. Before moving to this responsibility part in detail, I'll give you a small exercise to check your standard knowledge, IAS 10. Right? So write down in your exercise book, question 1. Write down in your exercise book, question 1. Identify following events. Identify following events as adjusting or non-adjusting event. Adjusting or non-adjusting events. Adjusting or non-adjusting events. Number 1. Allowances for damaged inventory. Allowances for damaged inventory. And doubtful receivables. Doubtful receivables. Whether it is an adjusting event or non-adjusting event. Issue of new share or loan capital after year end. After year end. Amount received. Amount received in respect of insurance claims which were being negotiated at the reporting date. Purchase of non-current asset after year end. Losses of inventory as a result of fire accident. Okay, the events are given here. 5 events given. Identify whether it is adjusting event or non-adjusting. Do it. Identify which events are adjusting events, which events are non-adjusting events. I told you to refer IAS 10, right? Can't remember. Okay, what is the first one? Allowance for damaged inventory and doubtful receivables. Adjusting event, very good. It's an adjusting event because the condition exists that year-end balance need to be adjusted. Second one, issue of new shares or loan capital after year-end. Non-adjusting event, very good. Amount received in respect of insurance claim which were being negotiated at the reporting date. Adjusting event, very good. Purchase of non-current asset after the year end. Non-adjusting event. Losses of inventory as a result of fire accident. Losses of inventory as a result of fire accident. The information is not enough, right? Accident after year end. It is a non-adjusting. Right. A fire accident. It is a non-adjusting. It's like this. The condition not exist before the year end.
Some of them like amalgamation and things like that. Even if the condition exists, it will be non-existing events, right? Like then we had a few examples.
No, it's like this. If the acquisition thing, if it is finalized and authorized before the year end, then it is adjusting event. Otherwise, it is not adjusting event. Got my point?
Like IAS 10, we had a few exemptions here. So I thought, anything related to a certain loss,
No, it's like this. Any sudden losses after the year end, right? It does not mean that the year end balances need to be adjusted. Disclosure is required.
Then it becomes adjusting.
I'll come to that point. I'll come to your point. I understood what you're asking now. The losses happened after the year end. And as a result of that loss, entities going concern ability is questionable. You got my point what I'm saying? This is a major inventory. Without this inventory, you can't operate. Right? That inventory is damaged. Now you need to close down the business. Going concern problem. Then it is an adjusting event. That's why when I put the flow chart, see here, going concern get affected, even though it is non-adjusting event, it should be treated as what? Adjusting event. Understood? Then they specifically mentioned, if such case, they will say it affect or key material is affected, like that. Okay? Right. Clear? Understood? This flow chart understood? Yes or no? This flow chart understood? Yes or no? Now concentrate. It's like this. The terminology need to be understood. The word amendment include adjusting event. What should we do? Adjusting event, we should adjust. So the adjust is also covered by amendment. If someone is saying financial statement need to be amended, it means it should be adjusted, right? And material non-adjusting event, but not affect going concern. Then what you should do? Disclose. This disclose also amendment. You got my point? So the word amendment means material adjusting event should be adjusted, material non-adjusting event should be disclosed. Both we called as amendment. Why I am teaching this? Because some students, they wrongly interpret the term called amendment as adjusting event. In your question, if you read financial statement need amendment, then you might think it is a adjusting part. It is not like that. Adjusting plus disclosure, both we call amendment only. Is it clear? Write it down this also. Right. Now concentrate. Now I come to this. Okay. So here we're going to discuss subsequent events, final review and misstatements, going concern, written representation part. Subsequent event I explained. Subsequent event is the event between year end to financial statement published. This event can be adjusting events and non-adjusting events. Adjusting event should be adjusted. Non-adjusting event should be. You should assess whether going concern affected or not. Affected, it is adjusting event. Not affected, material, it is disclosure. Adjusting events, examples given here, just go through. Non-adjusting events, examples given here, just go through. Focus more on these examples because these can be tested in the objective test questions. Okay. Auditor's responsibilities, ISA 560, right? So I gave the flow chart. That flow chart only you should draw here. Clear? Now concentrate. Between the date of financial statement and the date of auditor's report, what duty? Active duty or passive duty? Yes. So wherever it's possible, write it down. Active duty. So what is auditor's responsibility during active duty period? What is auditor's responsibility during active duty period? See here, auditor should perform audit procedures to identify the events that might require adjustment or disclosure in the financial statement. So performing procedure is voluntary or mandatory? Mandatory to perform. Understood? If material adjusting events are not adjusted, see, if material adjusting events are not adjusted or material non-adjusting events are not disclosed, material adjusting events are not adjusted or material non-adjusting events are not disclosed, the auditor will ask management to make necessary amendments in the financial statement. So even it is a disclosure, amendment, even it is an adjustment, amendment. So we ask management to amend financial statement. Understood? Now you know the term amendment. If the identified adjustments or disclosures necessary are not made, then auditor should consider the impact on auditor's report whether a modification opinion is necessary. There is a material adjusting event which is not adjusted by management. There is a material non-adjusting event which is not disclosed by the management. Both are material misstatement to financial statement. Understood? If material misstatement happened, Who is holding audit report now? Still not issued to management, right? Simply what he can do is he can change the opinion. You got my point? He can change the opinion. Understood? The responsibility is understood. Very, very important. This is what tested. Understood? First, you should perform procedure. And if there is any material adjusting event or material non-adjusting event, you ask management to amend financial statement. Don't use the word adjust here. Right? Amend financial statement. If it is amended, no worries. No problem. If it is not amended, change the opinion. Why? Because you only having audit report with you. No worries. Is it clear? Is it clear? Right. If you have a space under this slide, write down, or else wherever it's possible, write it down, a point. Later take a printout or go home and type. Okay. Write it down. During active duty period, during active duty period, during active duty period, during active duty period, always auditor hold audit report. Always auditor hold audit report. During active duty period, always auditor hold audit report. Therefore, if management refuse to amend financial statement, therefore, if management refuse to amend financial statement, refuse to amend financial statement, refuse to amend financial statement, management refuse to amend financial statement, auditor can modify audit report. Auditor can modify audit report. Second point, write down. Second point. During active duty period, during active duty period, during active duty period, if management refuse to, wait, during active duty period, if auditor, during active duty period, if auditor fails to perform subsequent event procedures, fails to perform subsequent event procedure that will increase detection risk, that will increase detection risk. So auditor should perform procedure as per the standard. If auditor fails to perform procedure, it will increase what? Detection risk. Now let's see what are the procedures generally we perform over subsequent event. Okay. See first one. Enquiring of management if they are aware any events adjusting or non-adjusting that have not yet been included or disclosed in the financial statement. If there is any subsequent event which is identified management, not yet adjusted, not yet disclosed, right? Those events they should disclose. You can inquire with the management. Number two, inquiring into management procedures or the system to identify the subsequent event. Management should maintain a control, a policy to identify the subsequent event of the company. So you can inquire what it is, how you identify subsequent event for your organization. Third one, reading board minutes and director meetings minutes to understand they discussed any subsequent event matters. Right? Fourth one, review accounting records including budget, forecast, cash flows. Why? To identify whether there is any subsequent adjusting or non-adjusting events covered by these forecast or budgets or whatever. Right? For example, like this. in the cash flow forecast, when you are preparing, right, we are estimating sales, right? Credit sales. You are estimating purchases, credit purchases, right? And like that, you are preparing budget, purchases budget, sales budget, right, for the future. When you are preparing, right, you identified, okay, these are the estimates. So they going to purchase from this supplier this much of quantity next year, this much of sales next year, right? And then you can see accounting records whether it is actually happened or not, to identify the subsequent events. If it is not happened, customer may be bankrupt. Last year budget I took, this year actual results I can compare, right? Management accounts and interim information. You can refer management account and interim information. What is interim information? IAS, interim financial reporting. So 1st of January to 31st of December, actual financial period. First quarter, January to March, that financial statement, to see whether there is any subsequent event. Obtain written representation. This is a common procedure you can write for all the finalization one, right? Whatever, even going concern or whatever. You always obtain written representation and request management to confirm it is correctly accounted and disclosed, right? And for legal cases, subsequent event legal matters, we can get the correspondence for the legal advisors, right? And reviewing progress of non-risk areas and contingencies, right? Non-risk areas and contingencies. Considering the relevant information which has come to auditor's attention from sources outside the entity, including public knowledge, competitors, suppliers, and the customers. Outside information, public information. Yes. Non-risk area, simply business risk and audit risk, both you need to be assessed. Through that risk, we can able to identify subsequent event. For example, fraud risk. If there is a fraud risk, right, if the controls related to the warehouse is weak, there is a possible theft to the inventory. It's a non-adjusting event. So risk assessment is important, right? Potential risk can create subsequent events. Inspecting after date received from receivable to ensure whether receivable is correctly recorded. Inspecting the cash book after the year end for payments received were not accrued to the year end. Accrual and prepayment. Inspecting sales price of inventories after the year end, NRV, cost NRV problem. You can assess through these procedures. So these procedures are very much important. Don't just by heart and rewrite, but most of the time you can take this procedure and relate to the scenario if you know these procedures. Okay. Between the date, this is also ISA's 560 responsibility. Between the date of auditor's report and the date of financial statement issued, active duty 1, active duty or passive duty 1, no, passive duty 2. Exactly, passive duty. Write it down, passive duty. This is 1, no? Passive duty 1. For your reference only, I just put as 1 and 2. The first one, see, the auditor is under no obligation to perform audit procedures. It is not mandatory to perform audit procedure during passive duty. Understood? This will normally be the form of asking the client to amend financial statement. The amendments need to be reissuing the auditor's report. So if there is any adjusting events or non-adjusting events, you ask management to amend. Right? If management amend, no issues, we are issuing a new audit report. Understood? If management do not amend the financial statements and the auditor's report has not yet been issued to the client, which means audit report is with auditor, then auditor can still modify opinion. Management is refusing, audit report is with auditor, and we can modify the report. Understood? If the auditor's report has been provided to client, now audit report is with whom? Client, management. Then the auditor shall notify management and charge with governance not to issue that financial statement before amendments are made. So please don't issue that financial statements before making these amendments. Management is not responding. No, you issued, it's our hand, we will do whatever we want. Right? Then what you can do? If the client issue financial statement despite being requested not by the auditor, auditor shall take action, prevent reliance on auditor's report. Auditor have a right to attend shareholders meeting. Yes or no? So if management is refusing, what you can do is you can attend a shareholder meeting in front of shareholders. Nicely you can disclose like this. There is an amendment which is material. We ask management to amend. They refuse. Don't rely on our audit report.
After the audit report is signed, also they have the right to attend.
Exactly. That's why I told subsequent event is year end to financial statement published to shareholders. You got my point. Once it is published, you can't do anything. Until that you can. But the role is different. Active duty, more influence. Passive duty, less influence. But still company law gave rights to auditor to disclose. Don't rely on our audit report because it is misstated. You got my point? Understood? And auditor should take the legal action also, advise, because integrity of management is questionable. Management fails to meet their responsibility. Okay. After financial statements are issued, passive duty 2. Passive duty 2. See here. The auditor is under no obligation to perform audit procedures. That is correct, right? The auditor should discuss the matter with management and consider if the financial statement require amendment. Understood? The auditor should perform audit procedures on the amendments to ensure they have been put thoroughly. If the management is adjusted, amended, then you should perform procedures to see whether it is right or wrong. The auditor should review the steps taken by management to ensure anyone who is received of the previously issued financial statement is informed. Right. So simply you can recall the financial statement and you can issue a new audit report if everything is fine. Right? When you are issuing new audit report, not like earlier. Earlier we gave a fresh report. True and fair view, fresh report. We didn't mention anything else. But under passive duty 2, auditor's report issued to management to financial statement published to shareholders. In between, if you identify the matter, if management amend everything correctly, we issuing a new audit report. Understood? The new audit report we issuing, we include emphasizes of matter paragraph. Still we are giving true and fair view only. But there is additional paragraph we put. What is the name of that paragraph? Emphasizes of matter paragraph. Right? I'll teach this. What emphasizes of matter under reporting topic. You got my point? We issuing a new audit report. True and fair view. But with emphasizes of matter paragraph. That is the difference. Otherwise, this procedure and the previous procedures, both responsibility, both are look like same. Here, if everything is perfect, we issue audit report, new audit report, but opinion, true and fair view with emphasizes of matter paragraph. Clear? Apart from that, if management refused to recall the financial statement, the same procedure. You can go to shareholder and inform, don't rely on our financial statement. Is it clear? Is it clear? Understood? Right. Now let's move to the question. Now let's move to the question. Do this question. Question number 1. Try out. Read it carefully and do it. Do it. Subsequent event procedures should be performed. Subsequent procedures should be performed between the date of financial statement and which date? And which date? Audit, the date subsequent event review is performed. Wrong. The date approval of financial statement. That is, financial statement is issued to public shareholders. Wrong. The date of auditor's report. The date of financial statement issued to management. This one. Correct answer is C. Correct answer is C. Understood? Actually, this is question number 2 only. Yeah? Okay, read this question now. You are an audit manager of B&N company and are approaching an end of audit of Samsung, which is a large listed retailer. Company is listed. The draft financial statements show a profit before tax 6.5 million, revenue 66 million for the financial year end June 2006. You have been informed that the finance director left May 2006. Before the year end or after the year end? Before the year end. As a part of subsequent event audit procedures, you reviewed post year end board meetings. Correct, right? You should do that. And discovered that the legal case for unfair dismissal has been brought against S by the finance director. Unfair dismissal. 9. Link to IAS 37 provision. During a discussion with the human resource director of S, you established that the company received a notice to propose legal claim 10th July 2006. Year end is 31st June 2006. This particular legal claim is receiving by 10th July 2006. Right? Subsequent event. The HR director told you that S lawyers believe that the finance director's claim is likely to be successful. Therefore, it is obligation is there. This obligation is probable. Cost is reliable 150,000. So provision need to be recognized. Best estimate is 150,000 is the maximum amount of compensation which would be paid. However, management does not intend to make any adjustments or disclosure in the financial statement. Is it an adjusting event or non-adjusting event? So management is not right. If after the financial statement have been issued to management, after financial statement issued to management, after financial statement issued to management, concentrate. If after financial statements have been issued to management, active duty or passive duty 1 or passive duty 2? Active duty or passive duty 1 or passive duty 2? Active duty or passive duty 1 or passive duty 2? That's why I told that particular flow chart, the chart is very much important. After issued to management. After issued to management means passive duty. After issued to management. Say, Concentrate. Year into audit report sign. Who hold audit report? Audit report signed to financial statement issued to management. Issuing date, right? Up to that period, who hold audit report? Both. Financial statement issued to management. After that, who hold? So here they said after issuing financial statement to management, which means passive duty 2. You have to understand that first. Based on that only you can reach answers. Okay. Becomes aware of a fact which may have caused report to be amended. Audit firm should consider several possible actions. Number 1, discuss the matter with management. If you know that, then only you can decide answer. Huh? Discuss the matter with management and where appropriate those charged with governance. One procedure. Obtain written representation from management. Another procedure. Consider the firm should resign from the engagement. Another procedure. Enquire management intent to address the matter in the financial statement where appropriate. What is the answer? Which of the following are appropriate actions, procedures? What is the answer? 1 and 4. Then why 2 is wrong? It's a procedure, right? Subsequent event procedure, it's a procedure. Why it is wrong? Very good. That's what I need. That procedure we should perform where? Active duty period. You should obtain written representation. If you already obtained, again under passive duty 2, no need to take written representation. You got my point. But all other procedures you should do. You got my point, what I'm saying? Correct answer is very good. B. Correct answer is B. Because obtaining written representation is a procedure. But where I take that? During active duty period, because we should perform procedure on that day. So no need to perform again. Correct answer is B. Very good. Question number 3. Read this question. It's actually question number 3. Yeah? C is a website design company whose year end was 31st December 2004. The audit is almost complete and the financial statements are due to be signed shortly. Profit before tax is 3.8 million. Revenue is 11.2 million. You might have a doubt. Why they gave this information? To compute materiality. Did we study anything related to materiality here? Yes. Sometimes you need to understand whether the matter is material or not. Right? Apart from that, all these scenarios are related to what? Reporting as well. Normally completion and reporting, single scenario you will get. When you are doing reporting, materiality is, you should compute materiality. Okay. During the audit, it has come to light that the key customer of P with the receivable balance year in 285,000 notified C that they are experiencing cash flow difficulties, so unable to make payments for the foreseeable future. So that customer is bankrupt. The finance director has notified the audit team that he will write off this balance as irrecoverable debt in the next year. It's an adjusting event. You should adjust to the current year. And he is telling we will write off next year. You can't. The audit assistant assigned the audit of C wants a better understanding the effect of subsequent event on the audit. Has made the following statements. Number 1. All material subsequent events require number of numbers in the financial statement to be adjusted. A non-adjusting event is a subsequent event which no amendments to current year financial statements are required. The auditor's responsibilities for subsequent events which occur prior to audit report being signed are differ from the responsibilities after the audit report has been issued. Next one. The auditor should request written representation confirming all relevant subsequent events have been disclosed. Okay. What is the answer? What is the answer? which are true. First one, all material subsequent event require numbers into financial statement to be adjusted. Wrong. Material adjusting events only need to be adjusted. Subsequent events, all the subsequent events are not adjusting events. Okay. A non-adjusting event is a subsequent event which no amendment to current financial statement require. That is also wrong. I told you disclosure also require amendment. The auditor's responsibilities for subsequent event which occur prior to audit report sign, active duty and passive duty. Responsibilities are different. Yes or no? That is correct. The auditor should request a written representation. The word see, auditor should request a written representation confirming all relevant. If that relevant word is not there, this is wrong. Not all subsequent events. All relevant subsequent events have been disclosed. Right? Adjusting events need to be adjusted. Relevant events need to be disclosed. Right? So that term is correct. D. Correct answer is D. Ooh. Okay, do part 1 first. From this question, do it part 1. Do it part 1. Take your own time and do it. Event 1, adjusting event or non-adjusting? Event 2, adjusting event or non-adjusting? Adjusting, non-adjusting. Right, let's see. G, grains, manufactures breakfast and 3 factories. Right. So, okay. What is the profit before taxation? 7.9 million. Year end? 31st December 2015. Fine. A fire. When this happens? 15 February 2016. So, after the year end, subsequent event. And what happens? A fire resulted after the year end. So, obviously, it is a non-adjusting event. Right? So, write down the answer. Event 1. Fire. Write down the answer. A fire has occurred at the largest of the company's distribution depots and property, plant and equipment in excess 650,000 damaged, comma, inventory 25,000 damaged. Second point. The company has contacted its insurance company and they have begun to investigate the likelihood of any payment. The likelihood of any payment. This fire incident not affect companies going concern, therefore it is a non-adjusting event. It is a non-adjusting event since condition exists after year end. Since condition exists after the year end. Okay, clear? Since the condition exists after the year end. You want to read me? This fire incident not affected companies going concern. Therefore, it is non-adjusting event since condition exists after the year end. Since condition exists after the year end. Clear? Continue. How much this one? Damage non-current asset 675,000. Why? Asset 650 plus inventory 25. 675,000 divided by your 7.9 million, right? 7.9 million, right? Profit or revenue? Profit into 100. What is the threshold? So what is the amount? $675,000 divided by 7.9 million into 100. What is the value? 8.5%. Standard threshold 5%. Material or immaterial? Material. Write down. Even though it is non-adjusting event, it represents 8.5% of PBT, which is material to financial statement. So this material adjusting event need to be sufficiently disclosed in the financial statement. Material, sorry, non-adjusting event. Sorry, thank you. Material non-adjusting event need to be sufficiently disclosed in the financial statement. Is it clear? Understood? This is how you should write answers. Fine. Don't write answer in the single word. What is single word? It is non-adjusting event. Okay. Shall we move to the procedure now? So for fire, what is the procedure? They ask audit procedures, part 2. Part 2. First I'll take the first event, procedure. Second event, procedure. Okay, procedures. Write it down. Obtain obtain schedule of damage property and agree to net book value to non-current asset register. Right. So the damage property, the list to be compared with what? Non-current asset register to confirm the value. This much of value of asset, it is destroyed. Clear? One procedure. Review correspondence. Correspondence is a kind of a confirmation. Review correspondence from insurance company confirming the amount of claim. Confirming the amount of claim. Right. So then you can recognize it as a contingent asset here. Schedule of damage means whatever the property damage, management prepare a schedule. Right. So that schedule. Discuss with directors. Discuss with directors whether they disclose the effect of the fire in financial statement. Whether they disclose the effect of fire in financial statement. Clear? Understood procedures? Fine. Apart from this, another procedure you can write. What is that procedure? It's a common procedure for everything. Obtain written representation from management that you can write. Okay. Right, now let's first one understood, right? Shall we move to the second part of the question? Inventory, event 2. On 18th February, this is also subsequent period. On 18th February, it was discovered that the large batch of grains, new brand Loopy Green Loops, held in inventory at the year end was defective. So this particular item contained too much of green food coloring chemical. To date, no sales of this particular product made. So cost of the defective batch, how much? 915,000. These defects cannot be corrected. Right. Scrap value how much? 50,000. So write down event 2 inventory. Inventory. Inventory cost 915,000 is defective due to excessive coloring, and the scrap value is 50,000, and scrap value is 50,000. This information obtained after year end. This information obtained after year end which provide additional evidence net realizable value is lower than cost. Net realizable value lower than cost. Therefore, this is an adjusting event. Therefore, this is an adjusting event, comma, financial statement require adjustment. Financial statement require adjustment. Financial statement require adjustment. Okay. Now let's compute the materiality. So 915,000 is the cost. Scrap value is 50,000. Therefore, 865,000. Correct, right? That is the overstatement, misstatement. Divided by 7.9 million into 100. What is the percentage? Is it somewhere 11%? 11%. No, make it 11%. Material or immaterial? So the above overstatement of inventory. Above overstatement of inventory representing 11% of PBT, which is therefore material adjusting event. Material adjusting event. Is it clear? Therefore, it is material adjusting event. Understood? Write down procedures, inventory procedures. Inventory procedures. Discuss with directors. Discuss with directors. And inquire if they are prepared to write down cost of inventory into scrap value, whether they adjust it or not, right? Number 2, discuss with management. Discuss with management how they assess scrap value 50,000, since net realizable value is an estimated value. Okay, and also you can write written representation here as well. Clear? Understood? Understood? Subsequent event understood? Right. Now let's move to this one. Right, first one, application of IAS 10, adjusting event and non-adjusting event. Understood? Auditor's responsibility, active duty, passive duty, passive duty. Understood? Audit procedures. Understood? Clear? Right. Now time is 3:30, right? 4 o'clock. Okay, let's take 10 minutes break. Let's take 10 minutes break. I'll start at 4:10. Okay? Take a break.